Okay. So of course, I'm needed by Friday, 12/12. Listen to that. Okay. Let's see here. Let's go ahead and go to the chapter 16. We'll finish this one up and look through it just to see what we have. We're gonna cut this a little short. This one. Um, so what we're gonna do is subsequent events. These are events that happen after any subsequent event is something that happened after the audit report date. So subsequent events are events that happen after the last day of the. They come in two flavors. Subsequent event one. This is an event. This is something that relates to something that happened prior to the year end. And we get more information. And the one is I have down here is a lawsuit. You settle a lawsuit, at a year end, maybe you estimated the lawsuit, but before year end, you didn't know that. So you couldn't, you didn't know exactly what the lawsuit was going to be. Okay. So limit type 2. After the year end. Is financially significant to usefulness of the financial statements. This is for big things usually. Big things and usually and things that are out of the ordinary. So this isn't for, things that happen. For instance, if they have a union, maybe they have a strike. Okay, that's not that big a deal. You know that sometimes that happens if they have a union. It's not that large of a thing usually. But they're for big things that happen, usually in the financial significance of financial structure of the operation. All right, so let's go through here. So a client settled a lawsuit that was estimated at year end. So sometime after the balance sheet date, it was, I said this wrong. scratch this, you know what, and it just put something stupid up here. Subsequent events are events that happen after the balance sheet date. The year end is usually 12/31, you know, it's after that. I'm sorry. Please make sure you change that. It's important. So something that happens after year end. So I have okay, so after year end, let's say that you have a client settle the lawsuit that was estimated at year end. So in your financial statements at year end, they didn't know what the lawsuit was going to be settled for, but after the balance sheet date, maybe January 3rd, January 4th, whatever, they settled the lawsuit. Now, notice that you have, you know, the actual amount that the lawsuit's going to be settled for, right? You don't have to, you know, so you have this estimate on the books, but then you have the actual amount. Now, if it happens to be exactly the same, you don't have to do anything. But what kind of what type of a subsequent event would that be? Type 1 or type 2?
Type 2?
Probably, well, like, it depends on the size of it, actually. That's not a bad, that is a possibility, depending on the size of the lawsuit. It's generally going to be a type 1 because it was actually recorded prior to year end. You know, the lawsuit was recorded prior to year end. Now we just have more information about it. If it was big enough, though, you know, if it was something that would end a company or make them incredibly profitable, yeah, it would be a type 2. I didn't put that in there. Okay. Client sold 40% of the common stock to an investor after year end. Ooh. So 40% of the company got sold. Now, notice this is after the year end. So this is a transaction that, unlike the lawsuit that was filed before year end, this is after year end. So if this is a subsequent event, would it be type 1 or type 2? Anyone? 2. Yeah, it's a significant thing. 40% of the company is huge. Um, and it happened after year end. So you want to give the reader, whoever's reading these financial statements, the information that, hey, by the way, somebody else owns 40% of this now. So if you're a bank looking at it or you know, another investor, that you know that there's this large amount of stock that was just sold after year end. Client introduced a new product after year end. Okay, it happened after year end. Is that a big thing or not ordinary? Probably not. This is probably neither. You know, and companies introduce new products all the time. And it'd be unlikely that you know that anyone would be big enough that it would be change the company. They, you know, significantly change the structure of the company. Okay. The client lost one of their 2 warehouses in a fire. I didn't say, oh wait, this is after year. This is I should say after year. Add this in. Okay, so they have two warehouses, they lose one in a fire. Is that going to be significant? Yep. That is a type two. And it changes, now they have half the warehouses they had before. Client merged with a major competitor. What would that be? Two. Yep. Okay, date of the audit report. This is what I put up there before that was wrong. Date of the audit report. The audit report is dated as of the last, oops, day of field work. Yeah. Generally, the auditor is not responsible for information after this date. So the day that they have gathered all their evidence, they pack up all their stuff and they walk out of the place. That is the last day of field work. That is the day that's going to go on the audit report. The release date usually happens after that, a week after or whatever it is. But the release date will be after the, the date of the audit report. And I say a week after, it could be 5 days, it could be 10 days, it could be, around the ballpark here. I just found some stuff I had for a different class. All right, continuing on. I'm checking, make sure the dual dating. Okay. Dual dating audit report. Um, During the time of the audit report date and the release date, Events may come to the attention of the auditor. So let me give you an example. Let's say that the date of the audit report, I'm making this up. It's not anywhere in here. Let's say the date of the audit report was February 2nd, 2026. Let's say that the release date was February 10th. So between these two dates, the auditor might come across something that's significant. Now, notice the audit report has not been released. So the question is, what do you do with that? And here's the reason why it's significant, because let's say something happens on February 7th. Something happens. It's significant. You got to put it in the report. The problem is the report is dated the 2nd, and so you have a choice to make. And the choice is either you change the date of the audit report to the 7th, or you do what they call dual dating. And dual dating is when you say, here's the desk day of fieldwork, except for this item, except for item 5. And part of the reason for doing that dual dating is that you gotta end the audit at some point. And if you keep moving it back, if you keep moving you keep coming across these, especially if a company that's really active, there's a lot of stuff going on. You can imagine that this could go on forever. So the idea is, okay, at some point you gotta kind of close the books and say, okay, everything has to be done by the 2nd. However, this one item 5, happened on this date, and you have 2 dates on the audit report. And by the way, I've seen audit reports that have 5 or 6 of these. If you have a company that's really going through a lot of stuff, it's not that unusual. Okay. Search for unrecorded liabilities. We talked about that, I think, before. I think we talked about that with cash, didn't we? Search for unrecorded liabilities. The main way to do that is probably one of the better ways to do that is using the cutoff bank statement. I know we talked about that. You're looking for things that were paid that were not on the books. So the cutoff bank statement is what we oftentimes use for that. Why isn't it bolding? Wrong thing. Yeah, I'm hitting the wrong thing. That's why it's not bolding. I'm even goofier than usual today. I was at the dentist. I had a root canal. My mind is all squishy right now. Okay. So cutoff bank statement is probably the probably the best way to look for those. You get the cutoff bank statement after the end of the year, and you look and see stuff that was paid that was not on the books. Usually stuff that's paid in that first 10 days or whatever after the end of the year should have been on the books. Not always, but certainly something we want to look at. Okay, management representation letter. This is a letter you hand to the management and they sign it. And it includes a whole bunch of stuff. Basically everything you relied upon for the audit. When you sit for the CPA exam, you'll look and see what it's on there. So it includes significant items the auditors relied upon during the audit. Okay, by itself, the management letter is not considered evidence. So, if you have a problem with something you're not sure of something and management says, well, I tell you what, we'll just put it in the management letter. We'll take responsibility for it, put it in the management letter. You can't do that. So the management letter is not considered evidence in and of itself. It's there to corroborate those things that you relied upon when doing the audit. If, I don't think you talked about it. If the CEO and and or CFO refuse to sign letter, a disclaimer of an opinion. So if the CEO or the CFO refuse to sign it, they get a disclaimer. Now, hopefully that'll make them sign it, but and I'm sure for most places it would, but if they refuse to sign it, because if they refuse to sign it, that means there's something in there. The inference is that something in there they are not, they don't want to sign to. So there's something in there that was false that they gave to you or misleading or whatever. Okay. Lawyer letter. By the way, this is the management representation letter. This is the last item that is given, last item that is the audit. How do I want to say it? It's not really evidence. Last item collected on the last day of field. And the reason I say that is the lawyer letter actually comes before it. In the book, it comes after it. Not sure why. Okay, actually, there's not much to do here with this low level. I think everything I have there is right. I'll highlight some stuff. The primary source for litigation is the client themselves. The client themselves are your first source for the information. That information is corroborated by the lawyer letter. And the lawyer letter is simply a letter asking the lawyer for any information on lawsuits, for instance, that are estimated as liabilities at year end. And the weird thing about it, the odd thing about it is the auditor should reach, the client and the auditor should reach an understanding about materiality. Notice we don't talk about materiality with the client. We keep that to ourselves. We don't want the client knowing what our materiality is because then they'll start pushing it. However, when it comes to lawsuits, the lawyer will say, well, what are we talking about? Are we talking about everything? Are we talking about, uh, the $200 loading dock, uh, mishap with a door, or what are we talking? And so you'll get it to the lawyer so that they know exactly what they're looking for. And the attorneys can limit their response to whatever that is. Obviously, for things that have not been filed yet or have not been brought to the attorney's attention, they're not going to know anything about, which is another reason why you talk to the client first. Not much else to add to that. Community misstatements to management. So misstatements. Material misstatements are communicated to management and to the board of directors or the audit committee, which is part of the board of directors. Now, sometimes immaterial misstatements as a community, I mean, as a courtesy to management. And sometimes, a manager, they'll say, look, I want to know everything, okay, I know if it's not material, whatever, but if there's a problem, we want to know and we want to fix it. So, we want to know everything that happens. Let's go communicate. Oh, I should say B. And that's not uncommon. So it won't be in the audit report. It won't be anything that happens, it's not gonna be anywhere, it's not gonna affect the opinion. But they say, look, just give us everything so that, if there is a problem anywhere, even if it's not material, we want to know, and so we can look at it. Review the engagement. For non-issuers, review of the engagement be completed after the release of the report. So after the release of the report, they can so the report's released. Now this is for non-issuers. This is AICPA rules. For issuers, it must be done before the release of the audit. Review of the engagement. Before the release of the audit report. So for issuers, it has to be done before. Non-issuers, it can be done after. Issuers, and if you think about issuers, issuers are usually large companies. And you want to have your ducks in a row before you release the audit report. So it's required that and there's some requirements that as to who can do this review and all that kind of stuff too. We're not going to get into it right now, but but for issuers, the review of the engagement must be completed before the release of the audit report. So you have to get all your ducks in a row and get it reviewed before it's released. And if you think about it, like smaller, if you're auditing like a small convenience store or something like that, well, the audit's important. It's not worth it to hang up the audit report for someone to review it, probably. But when it comes to large dollars and large risk, it needs to be done before. So this is the PCAOB rules. Other information in the audit report. I think I may have written this incorrectly. Um, this is, I believe, is about other information included in. Other information in the annual report. This is right. Ooh, no, don't do that. This is right. This is the annual report, not the audit report. Okay. So in the annual report, we'll usually have the structure of having They'll start out with other information. They'll tell you what they did for the year and blah, blah, blah. At some point, they'll have the financial statements. And the audit report. So this is what the annual report will, at least part of it. And the other information will be management discussion. Just what I covered some of the classes. DNA. There'll be other stuff in there too, but a lot of times they'll have information, they'll have condensed kind of, this is what our sales increased by, this is, what it was, whatever. And the question is, what happens when this information in the annual report does not match what's in the financial statements? So this is the problem. Let me give an example. In the other information, revenues are $500 million. Financial statements revenues equal 130 million. So what do you do with that? What do you do if they're releasing their annual report and they're showing information that's not the same as you have in the financial statement? And by the way, you sign up on the financial statements, not on the annual report. So what do you do with this if they are at, why is that? This is the Uber speaking cap. Ooh. Okay, so this is the problem. It went to full screen. That's why. Okay. Hey, I'm back. So, what do you do with this? So the annual report shows revenues in this other information that does not match up with the financial statements. There's a few things you can do. You can withhold the report. You can withdraw from the engagement. That's a pretty serious one. It'd be pretty. Or you can put the misleading information in the audit report. let's number these. Let me tell you what, let me put this up. Number these. You can put in your notes however you want, but I'm gonna do these. So one, so the report, two, oop, uh, government engagement, three, put the discrepancy in the audit report. So you have a few scenarios, and it probably, it probably really looks at how serious it is. If you would withhold the audit report, withdraw from the engagement, those are probably two fairly serious ones. If it's less serious, you may include it, the discrepancy in the audit report. And I don't know why I'm putting in report issuance. Uh, this the Novocaine still kicking in. Let's skip this. It is the same as above. The release date. The issuance is a release date. I think what they mean here is form an opinion. This is from the book, but these are not in the chronological order. Which there are some parts of the book that aren't in the chronological order. If they were, the last thing you do is the management representation. Okay, we're done with this one. I tell you what, let's take a break. When we come back. Mhm. Yeah, immaterial misstatements, things that are less than material, and this is usually as a courtesy to management. They'll say, can you just give us everything, it doesn't need to be in the report, doesn't need to be cleaned up in your work papers or anything, but just give us everything that we did wrong so that we can correct it. For example, you go through a bunch of invoices and you find some errors, but there's no material misstatement there. They might still say, well, we want to correct our books, so they may want that information. So even though you're not telling them to do that, they may want to do it. Okay. Let's say be back at, we'll start in on chapter 17. So we'll be back at 701. And we'll start in on 17. Okay, let's go to the last chapter of the course. Yay. And this is on reporting. I think we covered it. I think we talked about this a little bit earlier on. I can't remember. Audit reports. Can we talk about this? I don't know. It's a blur. All right. So we'll look at the audit report. So there's there's two types of reports. One's for non-issuers. These are people that aren't publicly traded. And on page 3, I think it is, we have the one for issuers. These are for people who are publicly traded. So let's go ahead and get started on this. So this is the independent auditor report. A lot of times they'll ask questions about the report, what it has, what it doesn't have in it. If they don't tell you which one they're talking about, whether it's in taking the CPA exam, assume it's the AICPA report. So if they don't tell you which report it is, assume it is the AICPA. And the AICPA one, the standard report is called the unmodified. This is a clean opinion. Clean report. And this is standardized language. And the reason I tell you this is, we always tell you guys not to plagiarize things. Well, if you become a CPA, you're required to use this terminology. You're required to plagiarize this. And interestingly, this is copyrighted by the AICPA. If you're not a CPA, you cannot use it. So you're required to use this. You can lose your license if you don't use this wording. So this is what I kind of looked at. Yeah, so we address it to the board of directors, shareholders and board of directors of the company usually. We don't address it to management. Management makes the financial statements. They should already know about the financial statements. We have independent auditors report. Must be independent. Okay. Start out, we have audited, and it says what we audited, the financial statements. Right off the bat, it gives the opinion. In our opinion, financial statements present fairly in all material respects. In other words, we don't look at everything. The financial position, that's just balance sheet and results of operations, that's income statement, and cash flows for the end, generally accepted accounting principles. United States of America. Okay, that's the opinion. They usually give it at the end of the audit report, but people would always just look for the opinion because everything else is standard. Yeah, it's all exactly the same. So the only thing that could be different would be the opinion. Okay. So, hey, basis for our opinion. We conduct our in accordance with the generally accepted auditing standards of the United States of America. If this was international standards, it'd be exactly the same thing, except it would say international auditing standards. Okay, so let's go through this. So lists out management's responsibility. Management is responsible for the financial statements. So the auditors are not responsible for the financial statements. Question is, what are they responsible for? They tell it up here. Basically, you're required to give them an opinion. Okay, this is new terminology. This is kind of new to the report, so this is one they'll probably test if they test anything on the CPA exam on this. In preparation of the financial statements, management is required to evaluate whether there are conditions or events considered in the aggregate. They raise substantial doubt about the company continuing to work as a going concern. So this is a client going bankrupt. Okay. So we look for financial for errors, whether they're due to fraud or error. Could be either. They're not always fraud. General Motors had a misstatement, 2009, I think it was, on their cash flows. It was pretty major, but it was just an error. Now, this is important. The risk of checking material misstatement resulting from fraud is higher. So we tell them right off the bat that looking for fraud is higher, is more difficult than if it's errors. If it's errors, a lot of times people just find it. You know, if someone enters $6 million for a stapler, it's going to hit somebody's budget, and somebody's budget is going to say, "Why is there $6 million in my budget for a stapler?" And you know, it usually gets found out that way. So oftentimes errors are found, whereas fraud is actively covered. Okay. We maintain an understanding of internal controls, but not for the purpose of expressing an opinion. And then also we say it again here, we conclude in our judgment. So this kind of goes along with the first one. So the first one is the first one talks about this is for the client to do. The client is required to do this one for the going concern. Okay. Yeah. This is the format of the reports. Yep. Okay. Yeah, and you have to use it. Even if it's confusing or whatever, yeah, you know, don't think, oh, I'll improve it. And when you look at the reports, they're all pretty much the same. Sometimes there's a little bit of different wording, but not much. For instance, the opinion, sometimes they'll have instead of financial position, they'll say balance sheet. Instead of results of operations, they'll say income statement. So sometimes they'll be a little bit different, but for the most part, it's exactly like this. Okay. So we have to, so the client management has to determine whether they're going bankrupt. Then we will do our own analysis whether they're going bankrupt. And this is what we talked about before. Auditor has not identified uncorrected material misstatements of other information. This is in the annual report. We talk about that for chapter 16. They actually come right out and say it. So we'll look at them and say, you know, if there's not anything that we see that's wrong, we'll put it right in there. If there's something wrong, we can either put it in there or withhold the report or withdraw from the engagement. Okay, here's one that's wacky, a little bit wacky. Key audit matters. Key audit matters are things that are reported to either the board of directors or the audit committee. And those are in charge of governments. And they are put in, tacked onto the audit report, the significant ones, not insignificant ones. The significant things are put in there. This is not every audit. They have to request this. So this is something that needs to be requested by the client. And the reason it might be requested is that they're using this report for financing or something like that. And, you know, a bank wants to know, well, okay, we know you got a clean report, but what discussions went on? You know, how much can we trust on this thing? And if there's something like, say, a problem with handling cash or something like that, well, it's in a bank's interest to know that before they give the loan out. Or to know that there isn't a problem with handling cash, there's nothing about it in there, then, you know, they'll have some assurance that that isn't a problem. So key audit matters, CAMs, signature, state, date, last day of field work, daily audit report, last day of field work. Oops. Talk about that. Okay, so let's go through the unmodified report. So the unmodified report is the state management's responsibility. Do we? Yes. Management is responsible for the financial statements. We are not. State the nature of the audit. Yep. Yeah, that's going to be a yes. You know, the nature of the audit, they actually go through and tell what they're looking for and all that. I don't know. I pulled these from CPA questions. Give an opinion on internal control. Do we? Get an understanding of internal control, but not for the purpose of expressing an opinion. Well, that's false. Indicate the amount of evidence needed to support an opinion. I think they do. I don't think I highlighted it. Here it is. We believe our audit evidence obtained is sufficient and appropriate to provide a basis for our opinion. Give an opinion that financial statements are correct. We do that? No. They present fairly in all material in all material respects. They could be misstated, just not materially, and still be fairly presented. So we say they present fairly in all material respects. We never say they're correct, that they're accurate, or anything like that. And if you're taking a CPA exam and you run across questions that say something about the financial statements being correct, it's a no. Indicate inconsistency between the other client provided information and the audit financial statements. That's true. If there are, if they are reported, they're in there. Now, if they withhold the audit report or withdraw, you don't have to worry about it because they're withholding the report or they're not going to issue a report. So if there are inconsistencies, they would be listed there. Reference audit work to be done if the client, let's just say has, not as. Oh, will be capital. Change that. Oh, no, it messed up everything. So if they are going bankrupt, we want to tell the reader. Now, this one, by the way, it was kind of new when I was going through, but and if you think about it, it kind of doesn't go with the report. The report's on the financial statements. If the company's going bankrupt, yeah, the financial statements will look bad, but they can still have their financial statements done, you know, without being materially misstated, even if they're going bankrupt. So you think, okay, well, that's up to the reader to determine that. Well, this is one of those things, there's an expectation gap. People that were reading the financial statements, how come this company got a clean audit report? They went bankrupt 4 months later. Well, that's not what their audit report is talking about. It's talking about, read the financial statements and make your own decision. Sorry, I'm getting mouth numb. Okay. Indicate that all material misstatements, whether from errors or fraud, are equally likely. Is that true? No. Risk of not presenting material fraud is higher. Yeah. By the action including significant matters provided by those in government, that's true. Those are the CAMs. E-audit matters. Okay, so those are for issuer, non-publicly traded companies. Now we go to publicly traded companies. This is the big stuff. This is PCAOB. These are companies that are usually much larger, not always, but usually much larger than the non-issuers. Starts out exactly the same. pretty much. We have audited. That's not any different. In our opinion, on material respects, present fairly in all material respects. Blah, blah, blah. Okay. Financial statements are company's responsibility. We are required to be independent. By the way, this is the one that when I was going through, we had to memorize this. Because sometimes they'd tell you to write the standard unqualified report, and this is it. Well, that's another thing. It's a little bit different. This one's called the unqualified instead of unmodified. It's called unqualified. So if you see unqualified, that means publicly traded. Unmodified means private. But you used to memorize this because they'd sometimes tell you to write the standard unqualified report. And if you memorized it, you probably passed the CPA exam. And if you didn't pass the CPA exam. Usually it's, like 30 points or whatever. And you need 75 to pass. You did it, you got it. All right. We connect our audit with the PCAOB. So this one is all about the PCAOB, and you'll see that again and again. They don't reference the AICPA, the auditing standards. They don't say the auditing standards generally accepted in the United States. PCAOB, where they're generally accepted, they don't care. It's their standards. Anything else there is pretty much the same. Blah blah blah. Move our audits provide a reasonable basis for our opinion. Critical audit matters. These are called CAMs, just like the other one, except there's CAM, not KAM. So there's key audit matters. Those are for non-issuers. Critical audit matters are those that are for publicly traded companies. Now, the key audit matters. These are not separate opinions. They are simply additional information to give to the reader to let them know kind of to put it in a context for what the financial statements are. Okay, these are some examples of key audit matters. Material accounting estimates, judgments of financial statements. I'll give you an example. So for instance, I'll give you one that's like relevant to today, and that is you see a lot of these companies now that have AI. Everything is AI, and those, they're spending billions on those. The question is, are those going to pay off? So here they have billions of dollars of research going into these, and they may be buying up research from other people. They may be buying up patents and all kinds of stuff. And the question is, how do you value that? You're valuing it based on some future, things. It can be kind of iffy. And just to let you know, artificial intelligence, when I was going through school, before we even had the internet, we had all this discussion on artificial intelligence, that it was going to replace everybody. Nobody was going to have a job. No one was going to go, you don't need to go to school anymore. Everything's going to be artificial intelligence. And it hasn't really come true like that. Now, it is possible that now is the time for it. So it is possible that that is, something, but it's also possible that these are going to be worthless. And it might be, and probably possible, it's probably likely that there's going to be a handful of companies that kind of control it. So anyway, that's a big if. So you see these financial statements and they're investing all this money, that's a big if. Okay, so critical audit matters. You identify the matter, you look at the principle of concern, kind of consideration. For instance, the AI would be the evaluation of it. Reference the valid financial statement accounts. What accounts are we talking about? And then you describe how you address that issue. Sign off on it. The only thing different between this sign off and the one that we have for the AICPA is you must tell them you've audited the company since whatever year. Okay, so unqualified report. State manager's responsibility. Positive. True. Safety auditors are registered with a PCAOB. That's actually true also. Give separate opinions on key audit matters. That is wrong in the way I wrote it. You should not be key audit matters. Take that out. These should be critical audit matters. Please change that. I redid this handout. Take out the key. Change that to critical. And that's false. We don't give separate opinions on those. So for instance, if we're worried about the evaluation of the AI assets, we don't put a separate opinion on those. It's all included in the audit report itself for the company as a whole. Indicate the opinion was based on audit evidence. It's true. Give an opinion on the financial statement based on reasonable assurance. That's true. Also, we don't give absolute assurance, we give reasonable assurance. Indicate the auditor is independent and conforming with SEC laws. I think that one is true. Yes, they've highlighted it. Independence with respect to the conformance with and the SEC. PCAOB and the see. Reference work to determine if the client has substantial doubt about continuing as a going concern. False. Not in there. Check to make sure. No, it's not in there. It used to not be in there, by the way. That's something new with the CPA. False. We don't actually say that either one is, they're equal. They don't say anything about it. Provide the option of including additional information. Yes, that would be the CAMs, the CAM. And tell people, by the way, look at this. This could be a problem. Okay. Emphasis of a matter. I should I should highlight these for a second, or tell you what these are about. Okay, I'm gonna leave it out. Emphasis of a matter and other matters do not change the audit opinion. So we're gonna talk about emphasis of a matter and other matters, and they do not, whatever the opinion is not gonna be changed, whether good or bad or whatever. They do not change the audit opinion. It's simply additional information. Emphasis of a matter is something that's already been reported. You're emphasizing it. It could be in any number of things. It could be, oh, by the way, take a look at this. They um, change their distributor from this to that or whatever it is. But it could be, so something that's already been reported. Now, there are two that are required. That's going concern and change in accounting principle. Going concern, let's do that one first. Is all the following except, and this one is somewhat tricky. It's already been reported in the financial disclosures in the footnotes. You recall that we had the company, the management must do their own analysis of whether they are going bankrupt. And if it is different than the auditors, there has to be some kind of a reconciliation of how they do it. The one that is wrong is this one, and this is fairly new that this one's wrong. And it's not within 1 year, it's at least 1 year. So it's not that different, but it increases the time frame. It used to always be within 1 year, but now it's at least 1 year. International standards are 2 years. US standards, it could be 1 year, it could be 18 months, it could be 3 years, but it has to be at least a year. Okay, emphasis of the matter is when generally accepted accounting principles are not consistently applied. Now, this is not that we have bad principles being used or incorrect ones being used. It's when they're switching from one gap to another. And these are very common because whenever a new accounting rule comes out that a company has to follow, you get one of these, so a new accounting rule comes out for whatever, healthcare, healthcare expenses. Okay, they have to follow. Well, last year they weren't. So you get this, the accepted accounting principles not consistently applied, but there are 4 principles that are allowed. It's not that they're doing something crazy, but they're going from one principle to another. Has which of the following characteristics? If it's used if management changes an accounting estimate, no, it's only accounting rules. An estimate, changing from, if you say this desk is going to last for 5 years and instead of 7 years, that's not what we're talking about. Used if management adopts an unacceptable accounting rule, no, that gets them a bad report. Must be used even if the financial impact is immaterial. It's immaterial, we don't care. Because we got bad attitudes or account. No. If it's not material, you don't report on it. It must be this one. and is used even if management agrees with it and says, yeah, this is, you know. So, and this is very common. These are very common. Whenever they come up with a new rule, you get one of these. There was one year, I think I can't remember what company we were doing, but I think they had 6 of these and a whole bunch of new accounting rules coming. Okay, other matters. And there are some other matters that come across from time to time. And one of those is for uncertainties. And it's just a highlight look. Oh, by the way, other matters. These are things that are not disclosed. So these are things that are not disclosed. The emphasis of the matter is for something that is disclosed. You say, oh, by the way, don't look past this. This is important. Other matters are for things that are not disclosed, and these are discretionary. Auditor can choose them or not. And generally, these are for things that are unusual. Unusual uncertainties. Oopsie daisy. An important subsequent event is issued for the additional circumstance, all the following except this one. You're not going to get into the audit part of it. We couldn't verify this inventory item. The opinion of the audit report should let them know whether this is material or not. If it's material and they couldn't verify it, it should be a disclaimer or a qualified. Group auditors. Oh, I hate this one. And if you guys hate it too, that's my goal. Get you guys to hate this as much as I hate it. I hate this one because this is where the international standards are superior to ours. Great reason. A group auditor is someone who audits the parent company. So for instance, if you're auditing Microsoft, you'd be the parent company. Component auditors are the ones that are doing subsidiaries. So if Microsoft owns subsidiaries, and I'm sure they do, those are called component auditors. They're usually much smaller than the group. So group auditor is the main one for the overall company, the large company, and the component auditor are those auditors of the subsidiaries, and the subsidiaries may need their own audits done. Which the following is not true. It's actually C. You can decide to share the responsibility or to take ownership of it, either one. They're never forced to rely on the component auditor's work. You can always go do work yourself. This is the one that is the materiality for the group level and the component level are the same. That's wrong. If you're doing the subsidiary, what's material to the subsidiary may not be material to the large company, right? For instance, like let's say $5 million. Microsoft owns this subsidiary. The subsidiary has a misstatement of $5 million, and to that subsidiary, it's material. It's not going to be material to Microsoft. So they don't use the same material. And you can get an adverse opinion on the subsidiary and you get a clean opinion from the group auditors. we already talked about these opinions, didn't we? Qualified, we talk about these? See, if you guys were on the ball, you'd say, yes, we have, and then you could leave. All right. Qualified opinion. Qualified opinion is when there is a material misstatement. These are brand new when I was going through. Ooh, qualified opinion, something new. Qualified opinions are we're using there is a material misstatement, but it is not pervasive. Either isolated to one or two accounts. So yeah, something is misstated. And maybe it's who knows why it's misstated, but it was misstated and it's usually like, you can give, so let's say that the, the auditors couldn't verify some of the accounts. So for instance, let's say some of the land accounts or something like that. Well, you can tell you can use this qualified opinion, and the qualified opinion says everything is okay except for, and that's why these are sometimes called except for opinions. Because they say everything is okay except for, and then they tell the bad stuff. So if it's just one account, let's say it's the land account. Whatever happened that you can't get the information you need for the land account, because everything is okay except for the land account. Now, what this tells the reader is, okay, the cash is okay, the accounts receivable are okay, the inventory is okay. The land account is questionable, but the rest of it's okay. So it's when there is a material misstatement. Material. Put that in. A material misstatement, but it does not go through all of the statements. Adverse is the worst opinion you can get. When material misstatement A. I don't know. And it is pervasive. It goes throughout all of the. This is when the financial statements are not GAAP. So they look at, they're not using GAAP. And not fairly presented. Cannot be relied upon. You guys get the idea. Okay, now for both the qualified and the adverse opinion, the misstatements are known and in the audit report. You put it right in the audit report. So misstatements are known and in the audit report. So it isn't like if they don't change the financial, by the way, you always hope that they change the financial statements. If you find a material misstatement, you tell them about it. If they, and with the hope that they will correct the financial statements before they are, not correct, but make the adjustments before those are released. If they start pounding on tables saying we're not going to do it, that's when they get qualified or adverse opinions. Just because they don't put it in their financial statements doesn't mean no one's going to know about it. You're going to put all of it right in the audit report. And anyone reading the audit report will not only know that you can't rely upon the financial statements, it also casts doubt on management themselves. They're trying to deceive you. It's fraud, right? So there isn't a reason for them not to make the changes that are necessary. For that reason, these two are rare. Qualified opinions and adverse opinions are rare. They're very rare in public accounting, but they're also rare just in general because they don't do, and hopefully, people will think reasonably about it and make the changes, even if they don't agree with those. So these are rare. Both of those are rare because the dollar amounts are already reported. Yeah, don't spell it. Okay, disclaimer of opinion. Disclaimer of an opinion is used. Auditors are unable to gather, you can't get enough information to form an opinion. A disclaimer is like giving them nothing. Here's our bill, here's nothing. So a disclaimer of an opinion is when you can't get enough information, you get enough information to form an opinion. As you have a disclaimer. Okay. Yeah, we'll talk about scope limitations. All right, scope limitations are when you're not allowed to look at the information you need. And they really come in two forms, but now they have three. And the reason I'm going to cover this is because of that. Client imposed scope limitation. The client refuses auditor access to required evidence. That's right, the client refuses. The client refuses to allow the auditors access to it. So the client says no. So you say, I want to talk to your attorney because we got to do this lawyer letter, and they say, no, you're not talking to my attorney. You say, I need to, and they say, forget it, you're not going to do it. That is a client imposed scope limitation. They also break this out, though. There is another type of client imposed scope limitation, and that's one that is sort of beyond the client's. The client caused it, but it's not really something that they are. Well, let me give you an example, and I'll see if I can follow a sentence from it. Example: the client for the audit after the year end. So, yeah, it's on the client that they didn't ask us for the audit earlier. But, it could be that the bank, whatever, said you guys need to have an audit, and they said it after year end. So this is a client imposed one, but oftentimes it's not because the client wanted it to happen. And this one they take a little bit softer view of that, notice that if they do it after year end, you do have some problems here. How do you get a cutoff? You weren't there on December 31st or whatever their year end was. So you can't get a cutoff. You can't do inventory. What was the inventory at year end? Don't know. We weren't there. So there are some problems with this, but it's a little bit less than the client saying, look, I'm not going to give you the information you need. Client imposed, this is circumstances beyond the client's. Beyond the client's control. And these you do take a little bit less of a. Let me give you an example of those. Example of those would be fires, thefts. Someone comes in and steals their computers. Things of that nature, things that are beyond the kind, I can't think of anything else right now. But these are things that, again, you take a little bit less of a hard line with these because it's not that they wanted to do it. The first one, which one of these is the most serious? C. So the client imposed one, usually they get a disclaimer. It's possible they don't, but usually they do. Okay. A scope limitation that is deemed possibly material and pervasive should have which type of opinion? Disclaimer. You might be tempted to give them the adverse opinion, but remember, you don't know. You don't know if it's misstated or not. They're not giving you the information you need. So they'll get a disclaimer. A scope limitation would be possibly material, but not pervasive. this could actually be two of them. Could be a disclaimer. Could also be qualified. And the qualified would be, oh, except for this, land that we couldn't verify, whatever. That would be the qualified. And remember, disclaimer is like giving somebody nothing. So if there is a scope limitation that is possibly material, you're not sure about it, you could give them a qualified and say, except for this amount that we can't, because it'll tell the reader that everything else is okay. It's not pervasive. Okay, everything, yeah, we couldn't verify the land, everything else is fine. Cash is fine, accounts receivable is fine, inventory is fine, all this stuff's fine except for land. A scope limitation is deemed to be not material and not pervasive. Should have which type of audit opinion? I'll let you guys answer this one. Scope limitation is deemed to be not material, so it's immaterial, and not pervasive. What type of opinion do they get? Actually, yeah, they get a clean out, it's not material. It's standard unmodified. And we're done with the class. Woohoo! Oh, right at 8 o'clock. See? I don't know why I'm saying C, but yeah. Okay. Any question on that? So I will send out the test tomorrow. It is due. No, not there. Oh. 16, 17, again, we emailed tomorrow. I should say tomorrow now. And it is due Friday the 12th. I said this before class. I don't know if everyone was here for it, but all course material must be turned in by 12/12, a week from tomorrow. Next week, week 16, I will be in class. Is for assistance and tutoring only. No new material will be covered. No new assignments will be given out. So I'll leave it up to you whether you need to come for the assistance or not. And by all means, if you need help with something, yeah, either come into the Zoom meeting or come into the classroom. But if you don't, if you have everything turned in and you're fine with what you turned in, then you don't need to come or to tune in on Zoom. So next week is actually supposed to be the testing week. That's when we do all the testing, the final exam week. And we're going to do that online. So, any questions? Okay, well, that will be it for the class then. Huh?
Professor, for the case study, is that our final example?
It counts as an exam now.
Is this going to be different from what you said tomorrow?
Yes. Yes, so this will be the chapter 17, 16 and 17 exam. That is something different. That actually relates more to chapter 10. But it's more just to see, it's more just to get used to dealing with clients. It does have specifics in there. The case, do I have it in my phone? You go ahead. Yeah, this case, good question. This case is well, it does have 10 things. Some of them are good, some are crazy, and you're gonna type it up. But it's also looking at more along the lines of how you deal with clients. And clients come in all shapes and sizes, they're all different. And we talked about how this was actually, as far as clients go, they're not that bad. I mean, they tell you, it isn't like you found all these crazy things when you're doing the audit. If you found all these things during the audit, you might be upset, but they're telling it to you before they do it. So there is some good things about this client, and being so, the tone of how you report these, write these up in a letter to, you know, you're going to want to be a little bit diplomatic in it. I don't know that this is enough to drop a client for. You seem pretty upfront and honest, but certainly you may have some questions about it, but at the same time, using professional tone and just explain, they want to, and you don't need to go into, as far as like some of the stuff. I can talk to our customers into placing orders early. Okay, don't go to AI and get 6 paragraphs on this. This is 1 or 2 sentences, and you don't need the backup. This is, can they do it? They're just asking, can we do this? Can we talk to some of our customers? They really kind of want yes or no's, but explaining to them why they can and can't do something. Well, I'll give you one that is okay, as we can ship every order. There's nothing wrong with that. You don't need to go into paragraphs about why that's okay. Yes, you can do that. Every order that is shipped and is out for delivery in a truck, bill of lading, you can do it. Again, these are usually like 1 or 2 sentences are usually fine. And again, the tone is, how do you actually address this to these people? You don't say that they're fraudulent, committing crimes and all that kind of stuff. You never say that, by the way. If they haven't been convicted of a crime, you get sued. Okay, questions? Yeah, so this counts as an exam. The 16 and 17 exam will be sent out tomorrow. Any questions? Any questions from viewers at home? Okay, well, that'll be it for this class, and great having you guys. There is the evaluations for this course and other ones are in Blackboard. It'll say course evaluation. If you click on that, you'll not only get the evaluation for this class, but your other classes too. So if you want to go there and do that. Other than that, that's it. All right, great having you guys.
Thanks. See you next week.
Yep.